Hello, and welcome to the Smart Money, Dumb Money Show. And I'm your host, Keith Richards of Value Trend Wealth Management. I'm President and Chief Portfolio Manager and a technical analyst with Value Trend. And this video is a recap of a couple of blogs that I write every week, but I always highlight a couple of extras for you on this video. So it's worth catching the video for not just getting the highlights of the blogs, but also to get another chart that you're not going to see on the blogs. So let's get started. The first blog that I want to talk about was our monthly barometer reading. And the barometer, for readers of my blog, I've been writing that blog for the better part of 15 years, and I have been tracking the barometer in one form or another for well over 20 years. Now, it's been refined over the years, but the principles are the same. The barometer measures risk and reward. And users of the barometer should understand that this is not a market timing vehicle. It simply measures which is in control, which is the higher probability, risk or reward. But we have to understand that at any moment on the stock market, there is both risk and reward present. So just because the barometer measures low risk and better reward potential, that does not mean that there's no risk on the market. There's always risk on the market. Just because the market says very high risk and less reward potential doesn't mean that the market's not, capable of going up. It could still very well go up. It's a relative measurement based on a number of factors that include trend, market breadth, which means amount of participation in broad numbers of stocks. It measures volatility statistics, and it measures sentiment. Sentiment being how different groups of market participants view the market, how bullish and how bearish they are. And finally, it also looks at seasonality, and it looks at good old-fashioned market valuations. So we're going to look at all of those factors pushed into one indicator, and that's called the barometer. So let's cut to the chase. What did the barometer measure this month? Well, it measured, as of Thursday the 3rd, I think it was, of March, it measured 6 out of a potential 8. What that means is that on a relative basis, where 8 is lowest risk, highest potential for profitability, and 0 is highest risk, lowest probability of returns, 6 is a pretty good reading. So we're still in a bullish market. Now, the caveat being that a week ago, if you watched my video from last week, I noted that the stock markets, the major indices, are measuring significantly over their 200-day moving averages. And so I noted on last week's blog and video that I expected a correction, particularly in the NASDAQ. Well, as I stand here today, coming into the end of the week of the 6th, that reality, that overbought status of the market is now presenting itself. And the NASDAQ in particular has sold off strongly. In other words, I was right. But that aside, that doesn't mean that the overall risk of the market beyond the probability, I won't even say potential, but the probability that I was looking at and talking about last week of a correction, that probability was high. It remains reasonably high for the next little while. But the 1 to 3 month outlook, which is what the barometer tends to look at, is bullish. So let's take a look at a couple of factors, and I'm going to just share the screen here. So I'm going to look at something, and this is your bonus chart, that I didn't present on the blog. So what I want to show you here is what's called the Sentiment Trader Risk Appetite Index. Now, sentimenttrader.com is a subscription-based service. I'm sharing a screen here out of my subscription, but I give full credit to them for their marvelous work in sentiment indicators. They have a plethora of them, but this is one of my favorites. And what it is a a coagulation, so to speak, of three different companies and their risk appetite indices. The sentiment trader takes all three of them and puts them into one indicator. So that uses the work of UBS, it uses the work of Citigroup and a group called Westpac. And it takes that, what they're looking at is risk appetite by all market players. It's not pitting smart money against dumb money, it's looking at all market players. And what we're seeing here is that the movement by risk takers, market players, has declined significantly. In fact, if we look here, just before the recent correction that we saw on the market that I was talking about the probability of last week, the risk appetite was very high. Anything above this red horizontal line is considered high risk appetite. People are very interested in taking on risk appetites. This past week, when we've seen the market sell off, you can see that appetite for risk has declined. And if there's one thing that I've noticed in this indicator, that it's extremely accurate, and I'll show you here, when it gets to a low point of predicting market lows. Now, the green line is the ultimate low appetite for risk, and that tends to be very strong buy signal. But any point around, a third of market players that are measured on these three companies' indices, when only about a third or so of them are interested in the stock market, it tends to be a good sign, because we want people to be scared. And if they're not scared, they're irrationally exuberant like they were here, and markets tend to round over. You can see there back in March, and you can see there's several points where when this indicator got low, it indicated a market low point as well. So we're heading towards that point, actually, as the market continues to sell off. So that's a good thing. I think we're going to be seeing the end of this current correction in the next very short term, maybe next week or so. Okay, so that is the barometer measurement. And I wanted to now bring you to the other blog I wrote, which is called A Contrarian Trading Opportunity. Now, anybody that's followed my work knows that I'm a big believer in sentiment indicators and contrarian investing. In fact, big news announcement is that I have been working very hard on a investment book on contrarian investment strategies. And it's going to be very unique, because I always gear my books, if you've read either of my two books in the past, I gear my books towards ordinary people so that you can understand and pragmatically use the lessons. So these tools that I'm going to talk about, including some very new tools I'm going over in the book, including alternative data. But alternative data is normally only available to institutions, but I've got some backdoor ways for ordinary people like you and I to look at alternative data sources. So watch for my upcoming book. But in the meantime, this is, in my opinion, a contrarian investment opportunity that we're looking at here, and that is in coal. Now, the reason I know it's a contrarian opportunity is because as soon as I say coal as an investment opportunity to someone, people tend to balk. Oh, isn't that against the clean green movement, the ESG movement, and all this sort of stuff? And absolutely. But here's the thing. You see, just like the oil trade back in October, when oil was $40 a barrel, and I was saying I think it's going to go to 60 to 65. So far, it's just over $60. So I'm being vindicated for that trade, I think. Oil was really out of favor. Everybody was going to put up windmills and solar panels and drive a Prius and live happily ever after. Well, it's not the way things work. Things don't change that quickly. And same with coal. Now, true enough, in North America, coal-powered electrical facilities are a dying breed. But where is the use of coal growing? I'll tell you, it's growing in India and China, which happen to be the fastest growing economies in the entire world. So appetite for coal is huge in that part of the world. And so we want to look at this very underloved sector because their economies are growing, and both India and China, I actually read a statement recently coming out of India saying they have no intention of getting involved with the clean energy movement. So they are sticking with fossil fuels, and they are using coal almost entirely for their power output. And as their economy grows, power is a big thing, and growth is a big thing to these countries. So there's a few coal stocks that I'm looking at here. So this is ARC Resources. Now, we don't own this, but we've got it on our buy list. Look at that nice little bottom formation. If it breaks this neckline, which if I remember correctly, the screen is sort of hard for me to read, but mid 50s, if it breaks that, you're going to see a very strong movement. You could get, 30% upside on this trade, possibly. You'll want to wait for that neckline to break. Now, here's one we do own, which is SunCoke Energy. They are coking is also used in, coal is used in the production of steel. Guess what another commodity is used a lot of in the reopening? Okay, reopening economy. Everybody's talking about it. Well, everybody's kind of overlooked the fact that coal is used in steel, and steel is a big part of industrial production. So we bought SunCoke, and you can see it broke around $6, and we see tons of upside on this stock. High risk position. I will note that despite this is not a recommendation for your portfolio, we bought it only in our aggressive platform. Take a look online, by the way, at the performance of our equity platform, which is a conservative platform, and the aggressive platform. Our aggressive platform has been trading things like this, contrarian type of play, and it has done exceedingly well in this environment. We love this trading environment because there's so much rotation going on, and we're seeing a rotation into coal right now. So it's not for the faint of heart. Perhaps if you are interested in the trade of coal, you can take a backdoor approach. And one of the more, I'm not going to use the word conservative because I don't think investing in coal could be considered conservative, but I will say perhaps less aggressive ways to buy West Shore terminals. Now, we don't own this stock, but it pays a dividend. I think it's about 3 or 4%. I think it's closer to 3% dividend while you wait. It recently broke its neckline here. The upside potential is kind of limited, but it's got a pretty steady cash flow. They don't just rely on coal. They're just like the name implies, they're a terminal based in Canada, and they ship products like coal to developing nations like China and India. So coal is one of their products, and they have contracts for shipping coal. That's set in stone, but if coal demand picks up overseas, then you will see that West Shore will probably reap some rewards from that. So that is it for those two blogs. And I just want to leave you with a couple of thoughts. Go to our website and click on performance and take a look at how the sector rotation that we've been doing has definitely paid off. And if you've been reading this blog, you know a lot of the rotational ideas that I have presented right here for you to follow. And if you follow those ideas, you've been participating in the same upside that we've seen. Now, if you're not rotating and if you're not comfortable with this kind of movement in your portfolio, then perhaps it's time to look at value trend, because that's what we do. This market is what we do well in. We actually do worse in buy and hold markets because there's very few opportunities. You tend to have to pile into the one sector that's moving and stay there, and often sectors get overbought, like technology was getting right up until say 2019 and early 2020. What happens is that it becomes a crowded trade, and as rotational investors, we have a problem with that. We love environments like this, where we can go into something undervalued that's broken out, trade it to the top, and move into the next thing. So if you believe that this market is going to be a little more volatile than it has been in the past, and maybe even see some sharp sell-offs in the coming year as valuations tend to stretch, time to look at value trend, because this is the environment that we thrive in. And we've proved that through many years of bull and bear markets, keeping your money safe and limiting your risk. Thank you for watching, and be sure to subscribe to this channel as well as our weekly blog. Have a great week.